Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the fourth quarter of 2017. My name is Nick Basso, and I am a portfolio administrator in Ironwood's Asset Management Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type those into the chat box on the GoToWebinar tool panel on your screen. I'll compile the questions, and we'll do our best to address all of them at the end. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, the floor is yours.
Thanks, Nick. Good evening, everyone. Thank you all for joining the call tonight. It's always nice to talk with everyone when the markets are at all-time highs, the portfolios are at all-time highs. We got some tax reform details today. The global economy is humming. We can all just sit back, relax. You guys really don't even need to be on this call. We can really just, go as is. No, I'm all kidding aside. These are times when we really need to make sure that we're being prudent with our portfolio, and we need to make sure that we're not becoming complacent. This is the exact time that we want to scrutinize our asset allocation and make sure that we're in the appropriate asset allocation for our goals and objectives. When the markets are at all-time highs, if it's time for us to pull back the reins a little bit, if our required rate of return to make our portfolio, to make our financial plan successful, if that's come down now because the market's done well, now is a good time to be de-risking portfolios when appropriate, and so you can work with your primary advisor to make sure that you're really looking at that each and every time folks come in. During times like this, I always like to bring that up because we tend to have a lot of our meetings reschedule. Like I said at the beginning, and I was kidding a little bit, but people do become complacent, and it's easy to just kind of let the portfolio do its thing, and every couple of months you check on it, and it's doing really well. The market's doing really well. We haven't seen very much volatility, so it's really easy to get lulled to sleep. But there's a reason that we get paid more over a long period of time for having a diversified portfolio and having some equity sprinkled in there, is because there are risks, and it's always good to examine those when the portfolios are at all-time highs versus having to take the pain and then examine your risk tolerance when markets are not doing so well. It's much easier, it's much better to do it now versus after some kind of risk event does occur. So I'm glad that everybody's here on the call. You guys are a step ahead by joining on the call. Topics to cover tonight, similar to what we've done in the past. I'm going to update some numbers. The global expansion keeps ticking. Like I said to begin with, central banks we got a little bit more clarity on what's going on there, so I'll update us there. Earnings have been looking really good. We'll talk about fundamentals, and we'll talk about just kind of letting history teach us a lesson. So global expansion picks up. The global economy is going really well right now. Global PMI Purchase Managers Index manufacturing numbers, 53.2. If you look across all of these, this is the global numbers all compiled together. 53.2 is the highest on this page for the global economy. If you look at developed markets, 54.2 is tied for the highest number on this. 51.7 for emerging markets, highest. So you kind of get my idea here. You look at Europe, you look at the United States, we see a lot of green over here. We have a 60 number in Germany. These are really, really good numbers for manufacturing. The global economy is not in imminent risk of a recession. Things are picking up, if anything, not slowing down. Europe, like I said, is doing very, very well. The U.S. is humming along okay. We don't anticipate any short-run risk of a recession. If we dive into the U.S. economy, we'll see that the 10-year Treasury this past quarter at the end of September was at 2.33%. It got as high as just over 2.4, and then it came back down to 2.35% as of today. ISM manufacturing numbers for the U.S., 58.8 in August, 60.8 in September. Those are really good numbers, guys. Anything over 50, we're expanding. So 58.8 and 60.8 are very, very good numbers in the manufacturing side of things. ISM non-manufacturing numbers, we had a 55.3 in August and then a 59.8 in September. Once again, over 50 is expanding. Those are, the 59.8 is a wonderful number. That's in the non-manufacturing ISM number, that's the 93rd month of expansion. Last month, the U.S. economy actually lost 33,000 jobs. It was to be expected because of the hurricanes, Irma and Harvey really had a lot to do with the September employment numbers. Even with those two hurricanes, and even though that we lost 33,000 jobs in September, unemployment still ticked down to 4.2%. So that's a very extremely low unemployment rate. Average hourly earnings increased by 2.9% year over year. The labor market is definitely tightening. We've got 138 weeks in a row as of this morning of weekly jobless claims under 300,000. That's the longest streak since 1970. So the labor market is tightening, and you're starting to see a little bit of wage pressure. For the second half of 2017, well, not the second half, but Q2 and Q3, the preliminary GDP numbers are at 3.1% for Q2 and 3% for Q3. So definitely an uptick in the last 6 months for GDP. This morning, productivity, we were expecting a number close to 2% productivity increase. We got a number of 3% productivity increase. Much higher than we've seen in the more recent history. So these numbers are if we had to categorize them, we're definitely not slowing down. If anything, we're picking up a little bit, and I'll kind of go through some reasons why I think we're picking up. But once again, this is still, even with the past 2 quarters of 3+% GDP growth, we're still in a recovery that has the lowest GDP recovery of the last 10 or so recoveries here. And we're starting to get to the point where it's becoming one of the longest recoveries, but because we haven't really recovered so much in GDP, we think that this could extend longer, especially if these tax reforms go through, very business-friendly tax reforms announced. They've been kind of announcing them throughout, but we got more details. We got a lot more details this morning. Really, if you were to sum it up, it looks like it's going to really help business and small business. And there's not a huge impact either way for individuals. You might be paying a little bit more or a little bit less depending on your situation. But the preliminary numbers doesn't look like the individual side is changing all that much. But on the business side, it's a pretty substantial tax difference from what we're used to in the past. So that's the economy. That the previous slide. This one is what the economy is doing in regards to GDP growth. And then if we look at the bull market that started March 2009, if we look at the last 10 bull markets, including the one that we're currently in, we want to just gauge, okay, where are we with relation to past bull markets? Well, in duration in months, we're at 103 months, which out of 10 bull markets is the fourth longest, okay? So the three that are in front of us here are 152 months, 153 months, and 150 months. So it's quite possible that we still have some innings left in this game as far as it goes duration in months. But also, we're not at the beginning of the game either. We're somewhere to the middle to late stages of this game, and that's why we really need to be prudent at these levels. When we look at the stock market as a price gain, you can see that we're up 242% price gains without dividends in this bull market, which is 6 out of 10. So we still have a ways to go. We have 300, 400, 400, 400, and 500% price gains. So we could have a lot more price gains if we use history as kind of a benchmark. So there are a lot of folks who say that the Dow Jones and the S&P they can't go higher. They could possibly go higher. We don't know what they're going to do. It's very difficult to tell what they're going to do. We have an educated guess on what they're going to do, but anything can happen on any day. As most of you know, not many people were predicting the financial crisis that happened in 2008, and price depreciation happened very quickly. So that's always a possibility. But if we look at, we're just saying, well, the Dow's gone up to, record levels, and we've had a really good run since 2009. Well, yeah, we have, and we've seen this story before too, and it could get better. And so we don't want to necessarily pull back all the risk. We still want to participate in this. We just need to make sure that we have the correct portfolio for our objectives and our goals. Okay. Price to earnings multiples. So this is where we start getting a little cautious on the domestic market. So if we look at valuation metrics, there are a few valuation metrics that are here. We've got the forward price to earnings multiple. We have the Case-Shiller price to earnings multiple, dividend yield, price to book, price to cash flow, earnings yield minus a bond yield. If we look at all of these and we say, okay, if we look at the last 25 years, where are we at compared to where we've been? Well, the forward PE multiple at 17.7, a little bit higher than its 25-year average. We're about half a standard deviation overvalued if we looked at that metric. If we looked at the Case-Shiller, similar story. We're about a half, 0.7 standard deviations overvalued. If we look at the dividend yield, we're earning 2.1% to hold the S&P right now. 25-year average is 2%. So we're actually right around fairly valued if you look at dividend yield. Same with price to book, 2.9, right in line. Price to cash flow, we're a little bit overvalued, almost 1 standard deviation outside of average value. And then if we look at the earnings yield, which is the PE multiple reversed, so you're looking at the S&P 500 really kind of like as a bond, and then you subtract the BAA yield, which is a type of bond yield, you get 1.3%. The average is usually negative 0.3%. And so we're actually undervalued, or another way to say that is stocks still look more attractive than bonds, domestic stocks, that is. So just because we're at almost 18 price to earnings multiple, it doesn't mean that the stock market can't go higher. If earnings go higher and the stock market stays where it's at, well, PEs will come down. If the stock market goes flying high and earnings don't improve, well, then your PE multiple is going to expand. We've had PE multiples higher than 20 on many occasions. 20 is kind of where we really start to get nervous, is when PE multiples become higher than 20. So we're not there quite yet, but we're definitely headed in that direction. Now, what exactly do PE multiples tell us? I think this is a really important slide, because it kind of shows the way that portfolio managers look at future returns, and it's very, very, very difficult to predict what an asset class is going to give us in the next 12 months. Very, very hard. This chart basically shows why it's very hard. If we know that the PE multiple is 17.7, if we were to chart every multiple every single year where the multiple is and where the next 12 months return of the S&P 500 was, we get this chart that looks like this. You can't really tell a pattern. Yeah, there's a regression line here, but it's not very good. 10% R squared. There's not a lot of fit to this line. Meaning, you tell me the PE multiple is 17.7, I can't really give you a good idea where the S&P 500 earnings are going to be over the next 12 months. It's a roll of the dice. They're all over the place. If we just looked at 17.7, maybe we look at this little path here. We got the worst is negative 20-some% over here. It's a little bit higher than 17.7, and the best, we'll say that it's this one here, which is 35% on the S&P 500. So they can be anywhere on a 12-month period. However, if you start to expand that 12 months to 5 years, now we have a much better fit to this line, 42%. Still not perfect, but it gives us a much better idea. And this is exactly what we try and do with not only the S&P 500, but with emerging markets, with international stocks. We try and figure out, okay, what's the current value? What are earnings going to do? Because ultimately earnings drive stock prices. What are multiples going to do? What do we expect the future return to be from each asset class, and what do we expect the risk to be from each asset class? Well, at 17.7, if we were to use this line here, that would tell us that we would expect somewhere probably between, I don't know exactly what this number is, but let's say it's between 5 and 8% return from the S&P 500. The simple way to look at this is it's less than if the price to earnings multiple was 16 or 15 or 14. So the higher that price to earnings multiple gets, the better the stock market's done, all else equal. And so that means that you fast forwarded some of your return expectations into earlier periods, meaning that we expect less in the future. So that's all that we're saying by this chart. It just means that at these valuation metrics, we're a little bit overvalued, and we expect less from our domestic holdings over the next 5 to 10 years, all else equal. Okay? Multiples and confidence. So multiples tend to follow confidence, and confidence numbers are at levels that we haven't seen since the early 2000s. No matter, this chart looks at the consumer confidence number, but if you look at the consumer sentiment number, the Michigan consumer sentiment number, any type of confidence numbers you look at, you're finding that we're at levels that we have not seen since the early 2000s, okay? So that tells me that probably we have some room for multiple expansion. So I wouldn't be surprised if PE multiples go from 17.7 to, let's say, 20. That would not surprise me with the latest consumer sentiment numbers. We're right at, basically right at just over 100, about 101. So every 10 points rise in sentiment, we have 3.5 multiple points. And it's not a perfect match, but we've got a correlation coefficient of 0.53. They move similar to each other. So we want to make sure that we look at those confidence numbers. They're going to be a leading indicator. It doesn't always mean that it's good to buy stocks when confidence is at all-time highs, though, because if you look at forward, it's going back to that PE multiple and look at the next 5 years return. It doesn't always paint the best picture. So we want to know these, but we don't want to make investment decisions based on confidence numbers either, because they can be counterintuitive sometimes. It just tells me that I wouldn't be surprised if multiples get stretched a little bit more from here. The employment market, like I said, the labor market is super tight right now. We get a labor report tomorrow. We're expecting kind of a correction from the negative 33,000 because of the hurricanes, kind of a nice report given, getting some of those jobs back that we lost in September. But once again, the unemployment rate, this was August, 4.4, but in September it was 4.2. Average annual earnings, this is wage growth, but average annual earnings are up 2.9%. And if you look at, I like to look at the Atlanta Fed. The Atlanta Fed has this wage growth tracker, which I tend to like to look at that a little bit more because it excludes workers that have been added within the last 12 months. So very new workers, it excludes those new workers, and it looks at, okay, if you've been employed for longer than a year, what has your wage increase been? And that number is 3.6. So that's a very good number for wage growth, and that ultimately will lead to some inflation, all else equal, given the labor market is so tight right now. Autos are the one thing here that have kind of pulled back a little bit. We probably are going to see a little uptick because of the hurricanes and the insurance losses. Housing keeps grinding upward. Real capital goods orders the trend looks really positive here, which is a recovery from 2016, 2015, and 2014 pullback. It's a continuation of that 2016. If we do get the tax reform in the way that it was presented this morning, I expect these numbers to go a lot higher with 1 year expensing of capital orders. Companies will be able to expense that over one year, not multiple years, and they're going to be able to repatriate cash that's abroad. So I would anticipate this number being juiced a little bit. Now, is that long lasting? Probably, anything that we get early on is going to be kind of a sugar high, and we'll want to make sure that if we have a run up in stocks, that these tax reforms, it can lead to better growth. But we might see 4 or 5% early, and then it falls back to 2.5%, 3% long run. So we want to make sure that we're cognizant of that too, and that inventories are still a little bit higher than we'd like to see them. Consumers look great. Like I said, average annual earnings are up 2.9%. Decent job market. Housing is still affordable, although if they change the mortgage tax, that's going to have a little bit of an impact on housing, in particular higher end housing. But housing still is affordable. Gasoline prices are still fairly low. Balance sheets of consumers look really good. We have almost $7.50 to every $1 in liabilities, and then net worth is at an all-time high as well. So that's the U.S. economy. Now let's take a look at international a little bit. So global GDP, like I said, is humming pretty well. We've got global, which includes the United States, at 5.7%. And if we look at global GDP growth versus corporate profits, earnings, Earnings are what drive stock prices. Over the long run, what a company earns drives its stock price. So you can see this uptick in global GDP here to almost 6%. This earnings per share tracks it pretty well. The 1 year year-over-year growth versus trailing earnings per share. So that is very positive on trailing earnings per share. The GDP growth is an indicator that we'll see earnings increase in the near term here. Europe in particular looks very good. They went through a double-dip recession, which we talked about in the past, and they're a few years behind the United States in several facets. One, unemployment. They still have a ways to go for unemployment to come back down. They still have a ways to go to gain back the growth that they lost during the double-dip recessions. Their monetary policy is still adding to the balance sheet, not taking away from the balance sheet. So Europe is about 3 or 4 years behind the United States. And with the opportunities there and with the valuation, we see a lot of opportunity in both Europe and Japan. This is a chart that just shows that sometimes the U.S. does really well. U.S. equities outperform international, and sometimes international outperforms U.S. And it just so happens that it's usually international outperforms, then domestic, international, domestic, international by a lot, domestic, international, domestic, international, domestic. We've had almost 10 years where there's been outperformance by the S&P 500. The largest U.S. companies have done really well compared to international companies. We wouldn't be surprised, and 2017 is the start of that. We see international stocks up over 20%, whereas the S&P 500 is up about 15, 16% for the year. So there's been some outperformance in 2017 from international, and this could be the first year of many years to come of outperformance in the international markets, and that's one reason why we want to make sure that we aren't just always looking at the S&P. It's not just about the S&P. It's about emerging markets. It's about Europe, Japan, all countries that are outside the United States as well. Here's another chart that kind of illustrates this point, and really where I want to take this is the gray line is the S&P 500. So you can see the S&P 500 is up 272% since March 2009. The international market's only up 117%. But above and beyond that, price, just because something's up a whole bunch, doesn't necessarily equate to it being overvalued. You need to look at what the earnings have done. So it's price and earnings. And so price to earnings for the S&P, we already talked about, almost 18, 17.7. If we look at international ex-US, PE multiple, 14.2. 20-year average, 16 for the S&P, 14.6 for international. So that tells me that investors right now, currently, are willing to pay a higher multiple, 17.7 times earnings, when they normally, over the last 20 years, have only been willing to pay 16. Whereas international, in history, over the past 20 years, they've been willing to pay 14.6, but currently are only paying 14.2. Dividends, pretty spot on for the 20-year average, 2.1 versus 2, 3.1 versus 3, okay? So if we see that the international markets are improving faster than the U.S., they have easy monetary policy in both Japan and in Europe, we have better valuation, we could have better earnings, we believe that international is poised to probably do better than domestic. It doesn't necessarily mean it's got to happen, but we think that international looks more attractive than domestic. Okay, let's talk central banks and interest rates. We've been in a 37-year bull market in bonds. Interest rates have been coming down. You can see just recently in the election kind of popped them back up a little bit. The Fed is starting to increase rates. They're starting to reduce their balance sheet. Unfortunately, the rest of the global monetary or global central banks are not doing that. They are still easing. So we have a big drag, and the U.S. rates have a big anchor on them, and it's the two big Bank of Japan and European Central Bank that are keeping rates low and keeping their balance sheets high, that has an anchor on U.S. rates as well. Because there's a lot of demand for U.S. rates because they're a lot higher than you can get outside the United States. We think that with this growth, especially in Europe and in Japan, we're starting to see a lot better growth there, that those central banks are going to start to do exactly what the U.S. central bank has started to do, which is increase rates and decrease their balance sheet. So if we looked at all of the global central banks during the recession, during the financial crisis since 2008, they've added to their balance sheets $11 trillion. The Fed alone added $3.5 trillion. Basically, we went from $1 trillion balance sheet and before the crisis to $4.5 trillion after the crisis. So that $11 trillion of monetary policy, monetary easing that's on mostly the ECB, the Fed, and the Bank of Japan, when they start to sop that up, it's going to have an impact in the bond market. We think that rates are going to go up, and we think that the higher growth we see outside the United States, the faster those other two are going to start increasing or making monetary policy more tight, and we're going to start to see rates climb. The Fed is actually going to be, they started in October buying $10 billion per month, and every quarter they're going to increase that by $10 billion. So in the first quarter of 2018, they're going to do $20 billion per month. Second quarter, $30 billion. Third quarter, $40 billion. By the fourth quarter of 2018, they're going to do $50 billion a month. And so in 2018, they plan on reducing their balance sheet to $4.5 trillion. In 2018, they're reducing it by almost $500 billion, $420 billion. Okay. 2019, $600 billion. They're going to reduce it. So we're going to get back to more normal levels on the Fed balance sheet in only a few years. If we add to that Bank of Japan, ECB doing similar things, that's where rates could possibly start to increase a lot faster than where the market believes that they're going to increase. Now, what happens if rates do increase? Ultimately, it is a good thing moving forward if rates increase. Household interest in the United States, so savers, as interest rates increase, we have we have 1.4 trillion in income right now. So as interest rates increase, that 1.4 trillion is going to become larger versus 350 billion. So roughly a fourth of that, that's in interest expense. So as interest rates go up, yes, expenses will go up, but household interest will go up way faster than expenses. While the 10-year Treasury is below 5% and it's increasing, it's usually a positive for stock prices. Once it goes above 5%, it tends to be a drag on stock prices. We are at 2.35% as of today. We have a long way to go before interest rates become a headwind for equity prices. Now, if they jumped up quickly, it could cause some problems in the equity markets. If they go up stable, we believe that that would be accompanied by positive growth outside the United States and other central banks starting to have to tighten a little bit and rates going up in a semi-orderly fashion, and maybe hindering equity prices a little bit, but with the growth would kind of offset that, the earnings would offset that. And so you've got maybe a stock market that does okay and a bond market that's flat or possibly a little bit negative, depending on the duration that you're looking at. So here are the Fed expectations versus the market expectations. You can see the Fed is blue. So the Fed believes that they're going to increase interest rates, the Fed funds rate, to 2.7%, 2.75 in the long run. The market thinks that the Fed's going to only go to 1.7% in the long run. Thus far, the Fed has not increased rates very rapidly. And the market has tended to be right over the last 2 years. And the Fed has come down to the market expectations. Going forward, we believe that the market's going to have to come up to the Fed expectations. And we think that there's a big disconnect here. And as soon as those other central banks that I mentioned start to have good growth and they have to start tightening, this is going to start to be more prevalent in our opinion. So I'm going to skip this slide. Not horribly important. So if we get back to duration has a big impact on your bond portfolio. I'm going to give an example here. If we look at this U.S. aggregate and we look at what's an impact of a 1% rise in interest rates, we can look at, you're going to have total return and you're going to have price return. Total return is going to be your price return plus your yield. So if we're looking at the U.S. aggregate and we're at 2.35% on a 10-year treasury right now, if we went up to 3.5% over the next 12 months, if your bond portfolio was the U.S. aggregate, your bond portfolio would lose nearly 6%, 5.9%. Okay, but you'd earn 2.6%, and so your total return would be a negative 3.3%. So 1% increase in interest rates will give you a total return of a negative 3.3% from the U.S. aggregate, which is just a middle of the road. It's a really good benchmark for total U.S. bond market. But you can see the impact of interest rates is very highly correlated with the duration of your bond. A 2-year bond, 2-year U.S. Treasury, interest rates go up by 1%, your price goes down by 2%, and your total return is negative 0.5%. Not a big deal. If you're in a 30-year Treasury and interest rates go up by 1%, your bond's going to lose 18% nearly, and your total return is going to be negative 15%. So that is why we are short duration. Most of our bonds are 2- and 3-year maturity type bonds. We don't want to get caught over here and have interest rates go up and be holding the bag and have our bond portfolio go down 18%. So our bond portfolio, we're giving up some yield by doing that. You know, we're not earning the same type of return, yield as a 30-year Treasury would be giving us, but we're not taking nearly the amount of risk either. And we've got some floating rate, we've got some high yield, which you can see in an increased interest rate environment because they have a yield advantage, we're still positive total returns. So that's definitely help or in our decision-making process when building the bond portfolio, we are positioned for increased interest rates, which if we're short duration and interest rates go up and our bonds mature, then we're going to have some money to put to work at higher rates. That's ultimately what we want to have happen. And so each time we see the 10-year Treasury go a little bit higher, that's very, very good for a lot of our clients. It means they're going to earn more from their bond portfolio going forward. How to navigate, stick to fundamentals. Okay, so once again, Q2 2017, we have our M2 supply is 70% of nominal GDP. This chart goes back a long way, and 70% is a very high number. There's still a lot of people who dislike this bull market and still are in cash. And I talk to a lot of folks in this career, and I've heard a lot of folks who the Dow got to 21,000, and they said that's just too high. It's too high. I went to cash. I'm still in cash. It went to 22,000. I went to cash. There's still a lot of people who don't believe this market rally, and it's not about trying to get it right, guys. That's a very hard game to play because you have to get multiple decisions correct. It's about building the correct portfolio. I say this all the time. I sound like a broken record, but it's really the most effective way is setting up a portfolio that's going to fit your cash flow needs. If you're in retirement and you need $100 grand from the portfolio each and every year, we just simply can't be all in equities. We need some safer assets to help us get that income and to help us have assets that go up or down no matter what happens tomorrow or the next year. But there's a lot of people who are in cash. That's all I'm trying to get at. Cash is paying nothing. These people are it's good that they call it the pain trade for a reason. It's because at some point, at some level, they give in and they say, I have to participate in this market. And then they buy. And it might not be the best time to buy, but it tends to make the market go up even higher. And that's what we could see. And we want to be very cognizant of that. I talk about this chart also, valuation metrics. We talked about this a little earlier. The earnings yield, so if you take that 17.7 PE multiple and you flip it upside down, 1 over 17.7, you get 5.7%. So if you looked at the S&P 500 as a bond, it is paying us 5.7% in dividends in yield. If you look at all the earnings based on the S&P, it's giving us as an investor 5.7% of our investment is coming back in earnings. So that's like if we put $100 in the S&P, we get $5.70 in earnings for that $100 that we put in. Okay, if we put $100 into a bond, the Moody's Baa yield, we'd only get $4.40. So that's just telling us that typically when the earnings yield is higher than the Moody's Baa yield, that it's more attractive to be in stocks than it is bonds. So in 2010, 11, and 12, when this gap was big, it was very advantageous for us to be buying the S&P. Unfortunately, it was very hard to do that because we had been through a very, very difficult financial crisis, and it wasn't fun to be in stocks back then, but it was one of the best times to be buying stocks. And then one of the most fun times in owning stocks, when your stocks were going up 30% per year for 3 years in a row, exactly opposite thing happened. Your earnings yield was significantly lower than your bond yield, and it was easy to own stocks then. Everybody wanted to own stocks, but that wasn't the most attractive place to be. So we just want to realize where we are on that. So even though we're still cautious on equities, we still believe that equities are a better place, all else equal, than bonds. Earnings, if we look at the analyst estimates for the next 12 months earnings, you can see that analyst estimates are pretty positive here. And ultimately, this is what drives stock prices. As earnings go up, if the multiple stays at 18 and earnings go up, the stock market's going to go up. If earnings go up and the multiple goes up, stocks are go even higher. So earnings estimates are things that we like to look at. Earnings have come in thus far this third quarter, and they look very, very good, especially some of the bigger companies. They posted some pretty extraordinary earnings calls, and we've seen their stock prices. The other day we had Intel, Microsoft, Amazon all up 7+%. These are big companies to be up 7% in a day, and some of them did. I mean, Amazon was up over 10, and Microsoft was up about 10. Those are very large companies to be up that much. But so earnings are very important. That's what drives these stock prices. Global earnings, and kind of a little bit more just on why we like to look at maybe a little bit more international exposure in the portfolio, is if we look at earnings since the recession, you can see the U.S. is at all-time high earnings. We're doing pretty well. Japan is at all-time high earnings, basically. Emerging markets, they're not even close to all-time high earnings. And their valuation metrics are also very attractive. So not only could we see emerging markets earnings go back to where they once were, but we could also see PE multiples or price to book multiples or valuations go higher. That's why even though emerging markets is up over 30% this year, we still are very optimistic on the outlook for emerging markets. And in Europe, once again, they're way below where they were for earnings, so it's the same story as the emerging markets here. And then we can look at the different price to earnings, global valuations. If we look at price to earnings for the first four, U.S. is a little overvalued, developed is right about in line, Europe is right about in line, Japan is way undervalued. There's a little bit more going on here, but then emerging markets is a little undervalued as well. So it just tells us that all else equal, U.S. probably want a little underweight, and some of these other ones we want a little overweight. We've gone over this slide in the past. There are some new people on the call, so I'll just spend a little bit of time. But basically, this is just trying to show us local bias, and you can look at it as a United States thing to kind of get an idea on how it can happen as a global thing. So if you're a U.S. investor, your stock portfolio is going to look about 75% U.S. stocks and about 25% global stocks. Even though if you look at global GDP, the U.S. only makes up 25% of GDP, and the rest of the world makes up 75%. So a U.S. investor is heavily overweight U.S. stocks, which makes a lot of sense. And to kind of illustrate this point, we subdivide the United States, and we say, okay, if we look at financials, where are most financial companies? Well, they're back east. And folks know those financials, and they're in their everyday lives. And so if you look at folks' portfolios, people who live in the east are 9% overweight in financials. If you look at folks in the west, they're 10% overweight technology. If you look at folks in the Midwest, they're 11% overweight in industrials. So you invest in what you know. Energy south, 14% overweight in energy. So you tend to invest in what you know. So U.S. investors, they really are comfortable with the S&P 500, with domestic companies that they know, that they see every single day, and their portfolio reflects this. We just want to make sure that we're being aware that there are other opportunities out there as well. Commodity prices, why we want to make a case for commodity prices. It's a very lowly correlated asset to both bonds and stocks, and they're at very attractive prices relative to their recent history. And if we get some global growth that's a little bit higher, or we get some U.S. growth that's maybe goosed a little bit because of this tax reform, we could see that some of these commodity prices could be in demand for some of the infrastructure spending and some of the demand side things that would pick up should we start seeing a lot more growth here in the United States and globally. A case for bonds. So if we looked at October 2007 until present, and we looked at the growth of $100,000, you would notice that all three of these, they're pretty close. So it's almost a 10-year period of time here. October 2007. This chart only goes through December 16th, but you can see no matter what portfolio you picked, you're pretty close here. But if you were to look at what happened during the recession, if you were all in the S&P 500, your portfolio that started at $100 grand is actually less than 50 grand. Whereas if you were in a 40-60 or a 60-40, you saw much. It was still bad. Don't get me wrong. You lost maybe 25% in a 60-40, and you lost 20% maybe in a 40-60. But it's a lot better than losing over 50%. And then slowly but surely, each portfolio recovered. You can see that the 40-60 recovered, just 2 years from the existing peak, whereas the 60-40 was just one more year after that, so 3 years. So this is why I'm so adamant about having the right portfolio. We can argue that this is one of the worst. That October 2007 was one of the worst times to start investing. But somebody who had the correct portfolio of stocks and bonds could live off of their portfolio and still able to have a full recovery in 3 years since if they started in 2000. Let's say they retired in 2007. They would have their portfolio back to basically where it was 2 years from then. And if they were in a 60-40, we're talking 3 years. If you were all in equities, this whole time you'd be living off your portfolio, you'd be taking money out. It's too much volatility if you have cash flow that needs to come from that portfolio. And you're looking at, 4.5, 5 years until it got back up to its levels. But over the longer run, you're giving up a little bit by taking less risk, but you're not giving up a ton. And then also just want to make sure that we're not letting emotions make our decisions. If you have a correct portfolio, you're going to be less likely to make knee-jerk reactions. And that's the number one reason why the average investor, this is Dalbar's survey that's done annually, and the average investor in this survey has earned 2.3%, whereas just the 60-40 portfolio has earned 7 almost. So you're 5%, 4.5%, 5% better off if you don't let those emotions help dictate your decision. But some folks start in the wrong portfolio, and so when they lose over 50%, of course they're going to be so worried about their future if they've lost 50%, and then they might make a knee-jerk reaction, which ends up costing them in total return. This is just basically the same type of conversation here, same time frame, a little bit longer, 98. We start and we end at the same spot, but you can see we had a lot less volatility with the 60-40 portfolio versus the 100% stock portfolio. So that's why, even though we don't like bonds, they still should be a staple of any diversified portfolio because they really help with the downside, the limiting the losses. And they also give you some income. Although it's not high right now, they still give you some income. I'm going to skip this slide. This is another important one. As a portfolio manager, we are trying to put together asset classes that we sit down and we say, okay, what are our capital market assumptions for the next 10 or 15 years? Here, we think emerging markets is going to have a 8% return over the next 10 years with a standard deviation of 15%. And we think international markets are going to have this return and this risk. And we think they're all going to be correlated in this way. Well, if we are good at making those capital market assumptions, then we can build a portfolio that reduces the amount of volatility it takes without necessarily giving up a lot of that return. And this chart shows exactly what that does. A Sharpe ratio is the amount of return you get per unit of risk that you take. So you always would like, a rational investor would always like to have a higher Sharpe ratio. So if we just looked at emerging markets over the past, from 1994 to 2015, I like this slide. It's getting a little old. I'm gonna have to find some updated info, but it shows the story here. You'll understand what I'm saying. So emerging markets, for every unit of risk that we took, we got 0.07 in return. If we're looking at international, we got a Sharpe ratio of 0.13. If we're looking at the Russell 2000, for every unit of risk we took, we got 0.34. If we look at the S&P 500, 0.38. If we combined all of these and we added in commodities and we added in some bonds, we can boost our Sharpe ratio up to 0.46, meaning we took a lot less risk than just the S&P 500, and we didn't give up a ton of return to do that. But we did give up a lot of risk, and that is what a portfolio manager is trying to do by bringing in all of these asset classes, is we're trying to increase this Sharpe ratio. I'm going to skip this slide. This slide, I just want to make sure that we're not lulled into sleep here, guys. It's been a long time. It's been almost 2 years. In February, it'll be 2 years since we had a pullback of greater than 3%. We had a pullback in early 2016, but we haven't seen one since then. The biggest pullback we've seen since early 2016 is negative 3%. You can see here that negative 3% over a 2-year period hardly ever happens. So we expect to have a pullback at some point. It doesn't mean that the bull market's over. It just means, like I said at the beginning of this presentation, now is the time to examine and be crucial and scrutinize your asset allocation and make sure that you're in the correct portfolio for your objectives. If we have new funds to put to work, maybe we look at dollar cost averaging. These are things that we can do during these types of periods to kind of give us a little bit more prudent strategy without necessarily timing the market. We want to be smart about things. This just shows we're at historically very, very, very low levels of volatility. We haven't seen this in fact, we haven't seen numbers lower than 10 on multiple occasions ever. So this is historically low volatility from early 2016 last year. We haven't had a pullback of more than 3%. We've been just cruising up. We need to be prudent. So all we're trying to show here. I've already kind of hit on this, so we'll kind of go through some of these. So returns through 2016 and year to date. Year to date, emerging markets up. Now this was as of September 30th. Emerging markets up 30%. Developed markets, they're up about 24%. The S&P is up about, I think, 17%. Small caps are up about 11, 12%. asset allocation portfolio, kind of right down the middle here. And then fixed income is our lagger, and commodities has been our lagger for many years now. But realize that what is at the bottom tends to go back at the top. So when we have sustained periods of time when things like commodities are at the bottom, when your portfolio has dividends and interest that's coming in, if we're not using those to live off of, we're buying things like commodities over the last 5 years, with the exception of last year when it was up 11.8%. But right now we've been with our cash flows, we've been buying some commodities because our target, let's say it's supposed to be 5. When everything else does well and commodities doesn't, your target of 5 goes down to, let's say, 4.7, and we need to make sure that we get that back up to 5. Which brings me to a few weeks ago, a lot of you, those of you that are clients, would have realized that you got a lot of trade confirmations. We did a full rebalance on the entire portfolio back about 3-4 weeks ago because we hit deviation targets inside the portfolios. So we had, a little bit too much emerging market exposure because it done really well. So we sold a little bit of emerging markets to get back to our targets, and we bought things like commodities and fixed income with those proceeds. So that kind of explains that rebalance that we did. Overweight, we really haven't changed these much because not much. I mean, we just been ticking up, and things have been similar to where they are. So our long-term projections haven't changed all that much. We still like commodities going forward. Developed international, as you can tell from this call, you probably understand that we like international and emerging markets better than we like domestic. Market neutral is kind of a bond alternative for us, so we have that in the portfolio a little bit more than normal. We like small caps with this tax reform. They haven't panned out thus far, but we'll continue to monitor those. We think that they have a higher benefit with this tax reform than larger cap companies because of where corporate taxes are. And then underweight long duration fixed income, as you can probably already tell. Domestic equities, it's not that we're way underweight domestic equities, we just prefer international. REITs and utilities are both asset classes that as interest rates go up, these two probably won't do as well as some other areas. So that's the story there, guys. With that, I'm going to go ahead and have Nick pull up the questions, and we can have a Q&A here.
Hey, thanks, Dean. And as he mentioned there, if everyone would take some time to type any questions or comments or thoughts into their GoToWebinar tool panel, we'll be glad to field those at this time. And I will start off with a question. Let's say your typical investor would almost certainly have a portion of their retirement assets invested in a market capitalization weighted S&P 500 ETF, for example, SPY. We keep hearing, and it's not just a rumor, that the top 10% of the companies in this S&P 500 control or comprise approximately 50% of the overall market capitalization of the S&P 500 at this time. So I guess the question is, what implications or concerns should the investor have with that being said?
That's one downfall with owning most S&P 500 exchange-traded funds or index mutual funds, especially in that large cap space. Like Nick said, right now, the top 50 S&P 500 companies, so 10%, top 50 of S&P 500 companies are approximately 50% of the market weight. So if you have a market weight S&P fund, it's not necessarily a bad or good or bad thing. It's just Warren Buffett says buy the S&P 500 and that's all you need to do. Well, simply that's one way you can accumulate wealth if you just don't look at it. But what happens if you buy a market weight S&P 500 is in a period like this, you'll end up with 50 companies that represent 50% of your portfolio. And so that's why it's really helpful to have other ETFs inside the portfolio, like small cap and mid cap and some other areas that you're really focused on, some active management inside the portfolio. Hopefully we have tax shelters to get active management. But yeah, one of the downfalls to a market weight S&P index or any index that's market weight is in a period where you have a few companies that are very, very large companies and doing very, very well, you end up owning more of those companies, which might not be the best long-term investment strategy.
Okay, well, at this time we have no further questions. So like we always like to say, if you go home and you sleep on it and you come up with some questions or comments, please feel free to email those to us or to your advisor. As always, we're happy to field anything like that. And I think I'm going to turn it back over to Sean here. You want to make some concluding comments, Sean?
I just wish everybody a great holiday season. Be safe, and we will do a 2018 view here relatively early in the year. So be on the lookout for that. We'll take a look at what 2018 will give us, and hopefully these stock market returns keep persisting, and everyone can be happy with their portfolio returns. So with that, thank you. Have a great holiday season, and we will talk to you in the new year.